Hello and welcome to this edition of Money Paathshaala special interviews. Joining me today is Sriram Iyer, who is the CEO at HDFC Pension Management Company. But more than that, 2.5 decades of diverse experience across different BFSI segments, insurance, banking, you name it. And Sriram has done that. Today's conversation, to my mind, is a very important one. A few years ago, the government, after years of work, brought in the national pension system, or the new pension scheme, as it's called, NPS. And today we are going to discuss with Sriram more about the NPS. I wish there was more conversations around it. It is a great product, of course, in evolution. It has made lots of changes within it, but to understand more about NPS, that it's not just a better tax-saving product, there's lots more to NPS. And for that, Sriram has been kind enough to take out time. Thank you very much, Sriram. Lovely talking to you.
Likewise, entirely my pleasure, Vivek. It's great to be with you.
My first question, Sriram, let's try and get some of the basics out of the way for people to understand. Sure. How is an NPS structured? I mean, who can invest in it? We do know government officials after a certain date are mandatorily required to put their pension through that. But for a private citizen, how is it structured, if you could tell us?
Sure. So the National Pension Scheme system, or the new pension scheme as it is popularly referred to, was launched in the year 2004. And this was launched primarily for government employees in 2004. Eventually, in 2009, it was opened up to what is referred to as private citizens, as you referred. Private citizens, which could be anybody who's a non-government employee as well, can contribute to the National Pension Scheme. In very simple terms, NPS is nothing but a retirement corpus accumulation tool, right? There are, of course, tax advantages and so on and so forth associated with investments into NPS. But very simply put, it is nothing but a long-term savings instrument, market-linked savings instrument that can help you create a significantly large corpus that one could use at the time of retirement. So in very simple terms, that's what it is. Resident Indians as well as non-resident Indians can invest in NPS. The age limit, actually, interestingly, has been enhanced from, so it's, once you turn 18, you can start investing in NPS. And you can actually invest in NPS right through the age of 70. So you could potentially open an NPS account at the age of 65. And in fact, I remember when the age limit was enhanced from 65 to 70, the PFRDA published, and during one of our meetings, they shared with us that there's 4,000 people, 4,000 individuals, all the age of 65 actually opened an account in NPS. So it's actually 18 to 70 Indian residents as well as non-resident Indians can open an NPS account. Low cost, market linked, retirement corpus accumulation tool in very simple sense. That's what NPS is all about. Yeah.
One hears about or reads about tier 1 accounts, tier 2 accounts. Can you tell us a little about what these are and who are they relevant to?
Sure. So the tier 1 account, as you rightly pointed out, there are two types of accounts. There is a tier 1 account and there is a tier 2 account. A tier 1 account is the account where you are eligible for tax advantages. So all the tax benefits that accrue to an individual accrue if you invest in tier 1 account. Tier 2 account is nothing but a simple investment management account. So it is very similar to let's say a mutual fund investment that you would make. So to that extent, there is no difference essentially between tier 2 account and let's say an investment that you would do in a mutual fund, an equity mutual fund, or a debt mutual fund, or a hybrid mutual fund. The only condition is that you can invest in a tier 2 account only if you have a tier 1 account. So it is compulsory for an individual to have a tier 1 account for you to be able to access the tier 2 account. But once you open a tier 1 account, you can actually invest in both of these. Tier 1 account has, given the fact that it is meant to help you create a corpus for retirement, there are restrictions in terms of how much you can withdraw, at what stages you can withdraw, how much can you withdraw prematurely. and what is it that you do when you do a full withdrawal at the time of superannuation, or in case you do a full withdrawal at, which is, prematurely. There are some restrictions around that. But on tier 2 account, it is a free account where you can get in and get out at will. You can actually invest in the four asset classes, actually there are four asset classes, but we'll just talk about three of those, which is equity, referred to as E category, corporate bonds, which is referred to as C category, and government securities, which is referred to as G category. So these are the three asset classes within the NPS architecture, E, C, G, and then there is the fourth asset category, which is called as A, or alternate asset class, which I will talk about a little later. So under tier 2 account, you can actually invest 100% of your money in E, C, or G, as the case may be, or a combination thereof. So there is no restriction in terms of how much you can invest in what category. And as I said earlier, you can enter and exit from a tier 2 account at will, right? So it's an account which is akin to a mutual fund account, an investment account. Tier 1 account, on the other hand, is an account where tax advantages accrue to you, and therefore there are restrictions in terms of not how much you can invest. Of course, you can invest as much as you want, but the quantum that you're eligible for tax that will give you tax benefits. There are limitations in terms of what is it that you will get as tax benefits, and we can delve into that as well. Withdrawal from that is restricted, and rightly so, because of the fact that it's a product which is expected to help you build a retirement corpus. So that's the key difference between tier 1 and tier 2. I hope I've been able to explain that appropriately.
So when you say tier 1, and just to understand this, I mean, the one big benefit that everybody highlights and talks about is the fact that under Section 80C, here the limit is 2 lakh instead of 1.5 lakh, as a combination of all other instruments, and that, I'm guessing, is relevant only to the old tax regime vis-a-vis the new tax regime. If you could explain that.
That's correct. So tier 1 account, essentially there are two benefits there are two types of benefits that would accrue to a subscriber or an investor, as the case. Typically NPS investors in NPS are referred to as subscribers. So a subscriber is eligible for two types of tax benefits under tier 1. So there is the 1.5 lakhs, which is the 80C limit that is available up to 1.5 lakhs, and of course there are other instruments that you can use to claim the 1.5 lakh benefit. But NPS also can be used for the purpose of claiming that 1.5 lakh benefit, assuming that you don't have a home loan and so on and so forth, because there is a interest expense on home loans can also be claimed under the 1.5 lakhs. Or if you don't have let's say, an investment in a public provident fund, that also get clubbed under 1.5 lakh. Let's say you don't have any of those, you can use the entire 1.5 lakhs for the purpose of claiming deduction if you've invested that amount under NPS. So that's number one. So that 1.5 lakhs is available to you in entirety or part thereof, as the case may be. There is another 50,000 which is available only for the purpose of investment in National Pension Scheme. That is referred to as Section 80 CCD 1B, right? And I'm not wanting to use jargon here, but the section under which this 50,000 gets covered is 80 CCD 1B. So you have 1.5 lakh rupees under the 80C umbrella, and you have another 50,000 rupees under the 80 CCD 1B umbrella. So this 2 lakh rupees, up to 2 lakh rupees of investment in NPS will therefore, get you a deduction as far as the old tax regime is concerned. I think you made a very, very valid point. Both of these are not available if you invest under the new tax regime, right? So under new tax regime, as an individual, you're not eligible for any kind of, deductions, and therefore it is not available to you under the new tax regime. However, I also want to point out the opportunity to save significant amount of tax for a salaried individual. For a salaried individual, NPS is an extremely attractive product because under Section 80 CCD 2, and forget the section for a moment, but it's important for you to know what is the section for your listeners and for your audience to know what is the section. Under 80 CCD 2, up to 10% of your basic compensation can be invested by you in NPS. And this gets invested pre your salary, by which I mean that if, let's say, somebody has a salary of, let's say, 10 lakh rupees, let's say 10 lakh rupees of basic, I'm just taking an example. you're eligible for 1 lakh rupees, up to 1 lakh rupees can be invested in NPS. It gets invested before the salary gets paid to you. Very similar to what Employee Provident Fund, EPF contributions, the way EPF contributions work. Similarly, NPS also can get, deducted from your salary, and therefore you're essentially saving whatever is getting invested in NPS under this 80CCD2, which is available specifically for salaried individuals. You save whatever is your tax slab. Let's say you're at a 33% tax slab, you save the entire 33% on the quantum that is going towards NPS. So for retail individuals, 50,000 plus 1.5 lakhs under the old tax regime. The 80CCD2, which is a corporate NPS tax advantage that I just, or the tax, tax reduction that is available that I was referring to, that is irrespective of new or old regime. You're eligible for it because it is really not a reduction. It is not a deduction that you're claiming as an individual subscriber, but it is a reduction that is happening from your salary before the salary gets paid out to you. So to that extent, 80CCD2 available irrespective of whether you've chosen the new regime or the old regime. 80C and 80CCD1B is available to you if you've chosen the old tax regime. For a final point that I want to make, for an individual corporate NPS subscriber, all of this is available to that individual. So the 10% of basic is available under 80CCD2, and if the person has chosen old tax regime, this incremental 1.5 lakhs and 50,000 is also available to the individual. So that's the tax advantage at the time of entering the product is concerned. So this product is referred to as an EEE product, which is an exempt product. At every stage, it is exempt. And I will try and explain that to you. So we spoke about the exemption available at the time of investment, which is under various sections that we spoke about. Any accrual that happens on this in the form of increase in market value, because these are market linked instruments. So the net asset value, as we'll know over long periods of time, will keep going up. Whatever is the gain that you're making in terms of net asset value is also exempt. So there is no tax. There's no tax that is attracted on increase in the value of your asset. And on maturity, right, which when one is superannuating, at that point of time, whatever is the corpus that comes out of this, 60% of the corpus is available, and I'm referring to a normal withdrawal on superannuation. 60% of the corpus is available to the individual in the form of cash tax-free, and the remaining 40% has to be used by the individual for the purchase of an annuity product. An annuity product is nothing but a product which will guarantee you a lifetime income at a rate which is fixed at the time of your purchase of the annuity. So it is a product which has exemptions up to certain limits at the time of investment, exemptions on gains that you make in the investment when you're participating, and when you're participated in the product, whatever gains accrue to you is obviously exempt. And the second part I'm pointing out, because unlike in fixed deposits, let's say, right, any increase in value or any interest that accrues to you, you actually pay tax on accrual, right? You don't even pay it on crystallization or on withdrawal. You actually pay on accrual, and that's the reason why it's important to point out that even at the time of enhancement of your value because market linked and the NAV going up, there's no taxation, there's no tax implication. And as I said, on maturity at the time of full withdrawal, 60% is tax free, completely comes to you in your hand, and the remaining 40% is also tax free. It just has to be used for the purchase of an annuity. That is a tax implication as far as the entire value chain is concerned, from investment to withdrawal.
What about tier 2? What is the taxation of the gains out there? Is it the same as what it would be, say, for a mutual fund? Whereas, of course, in the mutual fund, in the old tax regime, there was ELSS. But if you are in tier 2, I'm presuming that the benefits you talked about at the time of investing, as you mentioned, are not there. So while in a mutual fund, you still have the ELSS if you're opting for the old tax regime. But more importantly, since the intention is to build a corpus, a sizable corpus at the time of your retirement. So let's talk about that aspect. At the time, say if I'm in a tier 2, and if I've built a corpus over 20, 30 years, 40 years, uh, currently, if I'm in an equity scheme, there is an X capital gains taxation. If I'm in a debt
Right.
scheme, there is X. So what is it in NPS tier 2?
An interesting question, and this is a question that has been debated about for quite some time, ever since the product came into existence. Tier 2 as a product came into existence. I think there are different interpretations, and I'm not a tax advisor, and therefore I would refrain from giving a view on this. But I know of individuals who have chosen to treat investment in tier 2 very similar to what the way they would treat a mutual fund, right? By which I mean, if 65% or above of your exposure inside tier 2, which you can, as I said, it's flexible. If you've taken a more than 65% exposure in equity, you could potentially present that to the assessing officer as an equivalent to an equity mutual fund, and therefore long-term capital gains you could charge a tender. But having said that, the conservative view, or the view that I would subscribe to, because that's the most advisable thing to do, is the interpretation is that this will be treated at your marginal rate of tax, which may sound unattractive, but I think there are some phenomenal advantages that the tier 2 vehicle offers in the form of very, very low cost. Now, can you imagine a product where the product is actively managing? I mean, there is a full-time fund manager who's actively managing money for you at a cost of less than 9 basis points, right? Which is 1/20th to 1/30th of the cost that you would pay for active management for any other vehicle, right? Like a mutual fund would typically cost you between 1.5 and 2%. Here, the costs are, minuscule year on year. And as we all know, a rupee saved is a rupee earned. And of course, it also compounds, right? So every year, if you're going to be saving 1.3, 1.4%, and that compounds over a long period of time, then I think you're making significant savings through the life of the vehicle. I just want to make one point with respect to tier 2 and tier 1. The product allows for a one-time transfer of your corpus from tier 2 to tier 1 once in the life of your product, once in the life of the product. What do I mean by that? You could start a tier 2 account at some stage in your investment journey. Let's say at the initial stages of the investment journey, continue to contribute to tier 2 on superannuation, which is, let's say, at the age of 60. Whatever is your corpus that has got accumulated in tier 2 can be transferred once to tier 1. The moment you do that, it enjoys the same tax benefit as a tier 1, because it gets funged into the tier 1 corpus, and therefore, whatever advantage that you enjoy in tier 1, which is 60/40 that we discussed earlier, is availability on the corpus that has moved from tier 2 to tier 1 as well. So the law provides this, there is this dispensation that is available where you can move money from tier 2 to tier 1 once in the life of your of your NPS journey. So, right, so that's a big advantage that is available. So you could use this tier 2 account as a parking account, which a number of investors do. A number of savvy investors have understood the benefits of the tier 2 account, and therefore use it as a vehicle to park their monies in. And as I said, you could choose whatever asset class you want. And there are other investors who've chosen to continue to build a corpus through tier 2 as well, and on superannuation, move this money to tier 1.
So, Sriram, your regulator has also recently talked about this, and so have all of you, and perhaps for reasons that you and I both know, SWP, or the systematic withdrawal plan. I mean, today, if I were to go to, say, any company which offers annuity, I hardly get 5 or 6%, right? But if I have accumulated my investment through this low-cost vehicle, benefited from it, created a corpus, I should have the ability to withdraw how much and, when I want to, and at the same time, let the money continue to compound. Is that something? Right. And I know that your regulator is already talking about it, that,
right.
And again, even in the mutual funds, this has not been talked about as much as it should have.
Right.
But is that, according to you, could be a game changer? Because the problem is, okay, fine, I withdrew this 60%, I got it lump sum. Most people tend to go and blow it up, or when I say blow it up, I don't mean wasting it. I just mean
Sure.
They go and buy that house they've been waiting for, and overnight this money is gone, and
Absolutely.
then you're left with the balance 40, and you're not really getting the 12, 13, 14, whatever, the equity compounding while you keep withdrawing and drawing down. So do you see that that could be a big game changer, as in when that change is allowed? It's my money, I've accumulated it, let me draw down while that money continues to earn good returns for me.
Absolutely. So I just want to start from the point that you started right that you mentioned right in the beginning, which is around annuity, right? So the 60-40, which is currently available at the time of superannuation or post superannuation. By the way, you can continue to hold on to the balances in your NPS account right till the age of 75. You don't need to necessarily take the money out even after superannuation. And it, especially for salaried individuals or even for self-employed for that matter, more often than not, there are other sources of income that are, and for self-employed individuals, there is really no retirement age, right? I mean, they could continue to be in business well into their 60s and well into their 70s and well into their 80s also in some cases, right? Because they're actively involved and they're able to sort of add value to the business. So there is no compulsion, first of all, to take out the money at the age of 60. It's available to you at the age of 60, but there is no compulsion. That's point number one. Point number two, the 60% that you get as the corpus that is non-annuitized, right? So there is a commutation that's referred to as the commutation amount, right? So the commutation amount can actually be withdrawn by you in tranches right up to the age of 75. Okay, it is not a systematic withdrawal, but you can take out the remaining 60% in tranches over a period of time as well, right? That's point number two. Point number three, this 40% that is compulsorily to be compulsorily annuitized. Point number one, I think the rates on annuity are actually more attractive than the rates that you refer to. In fact, it ranges between 6.1, 6.2 to almost 7% now, right? And these are for what are referred to as single life or joint life with return of purchase price, by which I mean whatever is the quantum that you use to purchase the annuity on the demise of the individual, the corpus will go back to the nominee, on the demise of the individual. So it's a very attractive. In fact, in my opinion, 6.7, 6.8, and 6.9, those kind of rates are very attractive, because keep in mind that this is a rate that is locked in for the rest of the life of the individual. So if somebody buys this at the age of, and the rates that I'm referring to are for somebody who typically retires at the age of 60, right? Because the rate also changes as one gets older, because the mortality risk that the annuity service provider is assuming is lower, the rates actually increase with your age, right? So currently the rates that are available on annuity at the age of 60 is in the region of 6.7 to 7%, as the case may be. Different annuity service providers have different rates. But it's not a bad rate at all, in my opinion. And you're able to lock in this rate for the rest of your lifetime, which means that 10 years from now, if the interest rates were to come down to half of what it is, which is very likely. And I'm not sort of crystal ball gazing into what the rates will be 10 years from now. But we all know that in a developing economy like India, interest rates over long periods of time will have to come down, because that's the raw material for growth. Cost of money has to come down. And that's the sign of a developing economy as well, right? So very likely 10 years from now, the rates will be very different from what it is. And therefore, the 40% annuitization actually is a good deal. That's my view. Finally, with respect to the systematic withdrawal plan that has been under discussion for a while now, but I think the regulators have the decision on allowing systematic withdrawal plan has gone through. The board has approved it. And I'm referring to the PFRDA board, they've approved it. The CRAs, or the Central Record Keeping Agencies, which is the backbone of the NPS system, which essentially manage, as the name suggests, these are the agencies, and there are three of these which a subscriber could choose, one of Protean, KFinTech, or CAMS. Their system development is currently ongoing, and I think the chairman had put out a press statement to the press saying that before the end of this calendar year, the systematic withdrawal plan will be available to individuals. In my opinion, it can be game changer. I think and this is now being, of course, considered only for the 60% amount. The 40% amount will continue to be, required to be annuitized. So as per the current proposal, 60% of the corpus that is available at the time of maturity can be used for the systematic withdrawal plan. And lo and behold, in this case, the entire amount that you withdraw is tax-free, right? Unlike in a mutual fund where the gain portion is taxed, right? Only the principal portion, you obviously get an exemption on taxation. The gain portion is taxed. Here, the entire amount that comes out is tax-free. And as you rightly pointed out, the rest of the amount can continue to remain in the vehicle and continue to grow, right? At a fairly good rate. And, by the way, as per the current, all the changes that very, very positive changes that the regulators have done to the product, you can actually maintain up to 75% exposure in equity under tier 1, despite the fact that you may be beyond the age of 60, right? So you can actually continue to have a 75% exposure and continue to withdraw from that and let the remaining amount continue to compound at a fairly decent rate for the rest of its life. Yeah.
Which was exactly my point, right? Because supposing I'm looking at and that's a part of my other question to you, Sriram, that now it's been almost 10 years, right? Of performance for entities like you, and I was seeing the regulators, website itself keeps giving out a lot of data, and I was seeing that if you look at the last 9-10 years, many of the schemes have delivered over 12% compounded returns. So, when you're talking of, and I'm sure this number could go up significantly, may come down, but it is certainly much higher than the 6 to 7% that, the annuity forces me to get into. There should be an option, or perhaps maybe it already is, and one doesn't understand it, that as you said, that, I can be from 60 to 75, stay within my tier 1 and keep having a 75% exposure to equity, because if I have fulfilled other aspects of my goals, why should my money not compound at the rate of what equity compounds rather than 6 or 7%, which an annuity product will give me?
Absolutely right. And, that is exactly what the product enables. In fact, in the active choice, and we'll talk about active choice and auto choice maybe slightly later, but under the active choice option, where the individual is choosing the asset allocation, the dispensation of actually earlier, there was a requirement that the allocation in equity would need to come down to 50% by the age of 60, right? And this was the change that happened, if I recollect, if I remember correctly, I think the year before last or last year, regulator came out and said, there's no compulsion, active choice, it's up to the subscriber. You can continue to, hold 75% in equity, till the time that you exit from the product at the age of 75. So you're absolutely right. So that product does offer you that that portion of your corpus does offer you the ability to compound at fairly high degrees of, rates over long periods of time. Absolutely right.
And from one final question, from a fund management point of view, if you see the last 9 years, I know you haven't been with the company for 9 years, but I'm sure you have access to all the data. From a pure fund management point, since all the options, different asset classes, pure equity, pure debt are all available within NPS, how has the performance been vis-a-vis, say, the benchmark mutual fund kind of performance? Has it been pretty similar? Of course, no two fund managers will ever perform the same, but just to get a sense of the performance plus the cost benefit that you talked about.
So I think, firstly, if you look at the since inception performance of the funds that have been around for a long period of time, there are 7 fund managers that have spent almost anywhere in the region of 9 to 10 years. And we will complete 10 years in August 2023. So we would have completed 10 years of existence at that point of time. On equity, as you rightly pointed out, the returns have been in the range of compounded between 12 and 13% per annum. In our case, it's, I think, 12.7%, the last data that I recollect, which is the most recent data that I recollect. So 12.7% compounded, which is actually quite compelling. In fact, this is possibly the only actively managed product where NPS Trust, which is really the trustee or the custodian of all the assets that are held by the subscribers, it's held in trust with the NPS Trust. And NPS Trust is an intermediary of the PFRDA, right? The NPS Trust, which is charged with the responsibility of overseeing of course, one is holding the custody of all the assets that are held by invested by the various pension fund managers. it is also charged with the responsibility of overseeing the investment management function of all the pension fund managers. So both the PFRDA and the NPS Trust actually monitor our performance on a quarterly basis. Of course, we do not interfere in the fund management, per se, because that's entirely, left to the pension fund manager. But there are very clear guardrails that have been set, very clear boundaries that have been set in terms of what you can invest in. There are, of course, stock level, sector level, promoter level, and so on and so forth, rules that exist. And these have been defined by the PFRDA, both for equity as well as for corporate bonds, and government securities are government securities. So there are very clear boundaries that have been defined, and within these boundaries, the industry has performed exceptionally well, in my opinion. And the fact that the cost advantage of close to, and if you were to just take a hybrid fund, because, let's say a 75-25, typically a hybrid fund will cost you a total expense ratio of, I would suspect, between 1.5 and 1.75% per annum. Vis-a-vis that, we're talking about less than 10 bits, right? So you're saving 1.6, 1.7, 1.5 to 1.6% potentially by investing in a national pension scheme. And I'm not for a moment suggesting that, and all these products have their, space in the portfolio. You need to have, every product has a place in the portfolio, but I'm just purely from a cost perspective, comparing the two, is significantly cheaper, and therefore over long periods of time, it adds significantly to and in fact, the comparison of performance that we do on a quarterly basis, the NPS Trust during its reviews, when it does it, actually one of the comparisons that we do is against the family of large cap mutual funds. And I must tell you that this looked at very closely, and for various time horizons, if you look at the overall industry, it's done better than large cap mutual funds for different tenures as well. So I think overall performance has been fairly rock solid, not just in equity, but also in corporate bonds and the government securities portfolio. If you look at the C and the G category that I was referring to earlier as well, since inception, returns are upwards of 8.5-9% per annum return, so which I think is very, very, very attractive, right? So across all the three categories, the returns have actually been very, very encouraging. And I think investors must take advantage of the fact that, here's a low cost, tax advantaged, reasonably well performing vehicle that's available. And, one of the things that, Vivek, I just want to use this opportunity to also bust some myths around, people saying that, there's a, if product mein dalo to, paisa phas jata hai, you can't get out. And my view is that that's possibly the biggest positive feature about this product, right? Because the reality is that in a market-linked product, and especially in equity as a vehicle, equity by its very nature is a volatile asset class, right? So it's a feature, not a bug, right? So volatility is inbuilt into equity as an asset class. And all of us are human beings. We react when there is a so-called market meltdown, and there is a lot of noise around us. We tend to get out, get in, get out, get in, and therefore we lose out on returns in the long term. This product doesn't allow you to get out, right? Which in itself takes care of the behavioral bias that is exhibited by most individuals. And therefore you have no choice but to stay invested, and therefore you are willy-nilly going to make double-digit return, in my view. And of course,
yes.
And that's by far the biggest positive feature about this product, in my opinion. And I think, it's not very well understood. And I'm happy that, you're doing these sessions through your Money Paathshaala program.
I think because you are low cost, I think the flip side of it is that not too many people want to sell your product. So I guess we need to make people aware of it. Thank you very much, Sriram. It's been wonderful talking to you. It's such a vast subject. I'm going to keep coming back to you every month or couple of months and keep this conversation alive. Thank you for taking time out. Thank you.
Thank you. Thank you very much, Vivek. Thank you.